Hello, I'm Jared Nelson from the Investing Channel, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. Just last week, China reported its first quarter GDP data of 18.3%. Yes, that's correct, 18.3. This figure is the largest three-month growth in decades. So far, China has been recovering from the pandemic faster than most other countries. And given China's impressive economic rebound, when the rest of the world is still mired in sluggish growth, should we buy Chinese stocks now? The Chinese bull story is well known. Decades of uninterrupted growth has lifted millions out of poverty. Transformational change in the country's economic and financial well-being has created an influx of middle-class households. The spending power of Chinese consumers is legendary. Just ask LVMH. The company, now Europe's largest at €318 billion, is riding high on China's luxury spending. Its first quarter sales are up 30% year on year. China's stock market, which started as late as 1990, is now the world's second largest. The local CSI 300 index soared to all-time highs just recently. Scores of Chinese stocks worth more than $100 billion are listed across the globe, including the Shanghai, Hong Kong, and U.S. stock exchanges. Against this bullish backdrop, it seems that most investors with medium-term horizon should consider holding some Chinese equities. The world order is changing, asserted Ray Dalio last year, adding that one way to look at China's relative power is that with 4 times the U.S. population, when its per capita income reaches half the U.S.'s in about 25 years, its economy will be twice as large. The question for many is not that they don't know all these points, rather, they are wondering what's the best way to ride out the Chinese century, as some called it. The first method is to buy Chinese stocks directly. But the country's capital flow restrictions means that many large institutional investors are deterred. Another way is to buy Chinese stocks listed elsewhere in Asia, such as Hong Kong. For example, one of the largest tech stocks, Tencent Holdings, is listed there. The third way is to trade Chinese stocks listed in the U.S. In NASDAQ, for instance, there's a group of well-known Chinese tech stocks, such as Alibaba, Pinduoduo, JD.com, and Baidu, available to U.S. investors. These companies are large, liquid, and are on a bull run. Alternatively, you buy stocks that have huge operations in China and are heavily dependent on Chinese consumption to drive their businesses, such as LVMH or Kering. The drawback of this approach is that these stocks are exposed to many other factors at the same time. Finally, you can gain exposure to Chinese stocks via funds, including exchange-traded funds. Again, there are many ETFs catering for this niche market. Trackstar IQ, our proprietary search tracking tool, is showing growing interest in China-focused ETFs in recent weeks. Some ETFs are based on the MSCI China Index, while some are based on the CSI 300 Index. iShares MSCI China ETF, a fund with $6 billion assets under management, is based on the former. To many US-based or Europe-based investors, an ETF is the simplest way to hold a diversified basket of Chinese stocks across continents. However, is buying Chinese stocks a one-way bet that will outperform over the long term? Many are skeptical. The country's official economic figures are often distrusted given the opacity of their statistical methods. Debt levels are sometimes hard to estimate, too. Moreover, accounting frauds flare up from time to time. Luckin Coffee was the latest to implode last year. The other issue concerns the ongoing transition of the Chinese economy from export-led to consumption-driven. Can the country pivot successfully without encountering economic turbulence? It will take time and capital to upgrade the economy, an upgrade fraught with risk as consumer debt accumulates. Another point worth mentioning is that economic growth does not translate to financial gains. Over the last few decades, China has been reporting good growth figures year in, year out, but the stock market has experienced multiple boom-bust cycles. Investors who bought at the wrong time have suffered tremendously. The last worrying issue is the competition between the U.S. and China. Geopolitical tensions are intensifying. The rise of China is one of the biggest events in our lifetime. The country has leapfrogged many countries in just 2 generations. This presents an enormous opportunity for investors over the long term. Furthermore, as China industrializes into newer tech sectors, it pays to take long-term bets. One example is the electric vehicle sector. NIO, XPeng, and Li Auto, all of which we have covered over the past year, have generated substantial gains for shareholders this year. From the risk-reward perspective, however, it pays to buy Chinese stocks when they're down. As Chinese-related stocks are unwinding some of their earlier gains, perhaps now is the time to look at them. That's all we have time for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.